Cori, thanks for taking the time to jump on a Zoom call with me and talk a little bit about what all our clients are facing.
Absolutely. I think it's on the mind of everybody, every investor that I speak with, every investor that you speak with. Yeah, we're talking about like interest rates. We're talking about inflation. We're talking about like, how do I make these numbers work? So let's get in. I know you and I always have conversations, but I think just for everyone, we have a good recording of it and we can talk a little more.
That way, yeah, they can see exactly what we talk about. You and I go back and forth plenty of times. And what's really funny is how many people we're talking with right now. It's like, man, I've been meaning to do this for the last couple of years, and I finally got enough courage to move forward. And I feel like I'm getting it at the wrong time. And this is 100% to show people there's no such thing as the wrong time, in my opinion. Unless, go backwards to the crash. If you're buying right there in 2008, the very last minute, right? August of 2008, yeah, probably wasn't the best time. But outside of that, right now, in my opinion, is a phenomenal time. So we'll just go over some questions, some math together, if you're cool with that.
Absolutely. Yeah. And I love what you said, because it's that cost of inaction. When's the best time to start? Today. Yeah. So, yeah.
Yeah.
I love it.
So, and people try to time the market. Let me just tell you, the biggest mistake I hear people do is trying to time the market. I equate that to being a star football player sitting on the bench, watching the game, saying, I'm going to hold back my energy until it's the perfect time to jump on the field and get on the highlight reel. But what you'll realize is the only people on the highlight reel are already on the field. So if you're going to try and time the market, you're going to completely miss it. Just jump on the field and you will be in the game when that is that perfect time. You'll be in the game still when it's not the most perfect time, but what we're going to show you is it's still going to work out. So first off, we're going to set some baselines. And what I want to set for somebody is just general numbers. I know that some of these numbers may not work in all markets. We're using something that's easy for the math. So we're going to set this as a $100,000 acquisition. So $100,000 purchase price, 20% down, a 1% rent to value ratio, a 30-year fixed loan with $200 a month in cash flow. Does any of that sound completely unachievable?
No.
Not at all. Okay. So if we're doing a $100,000 acquisition and we're putting 20% down, what dollar amount is that 20%?
20,000.
20,000 bucks, right? And these are not going to be real hard answers. I'm going to try and keep this is so.
I'm not a mathematician, but even I can do that one.
Yes, exactly. And the point is, those who are listening or watching, they can immediately in their own mind picture this, and we can sync up all our brains. So it's 20,000. So that means your loan amount is how much?
80,000.
80,000. And my argument with everybody we do business with is that they are proposing to become the CEO of their startup real estate investment business. And when they start that, they need to get their mind right about how a CEO acts, right? And most of the time, the CEO is not going to go around and shop for the cheapest, or the people that would take the lowest income. Can I find somebody to be my COO and my CIO and all these positions and take minimum wage? Doesn't happen that way, right?
Sure.
Because then they're going to do nothing but their jobs themselves. So then I'm going to argue that's job number one, find the right people. Well, in my opinion, they've already chosen a chief operations officer in you, Cori. You're going to help them to find the markets that make sense, how to interview the people within those markets that they're going to decide are going to source, acquire, rehab, manage, and maintain their business, right? A complete operations division for free in the deal, right?
Yeah.
Now, the reason I say for free, because they're going to argue is like, wait a minute, I'm paying full price for this house. But when you go out in the market and you're shopping, just driving streets looking for sale signs, is that person selling it at a discount, or is their realtor selling it at full market value?
Their realtor is selling absolutely full market value, and especially now even over. Exactly.
Over market value. You're going to say, oh, yeah, make your offer. Then we're going to do highest and best at the end of the week. And they're going to try and push it 30, 40, 50,000 over market.
Yep.
Now, when that realtor closes on that deal, where are they 6, 8, 10 months later?
Selling somebody else a house.
Exactly. I mean, they're not necessarily still involved helping them manage their business and operate that. At best case scenario, Christmas time, you'll get a card with them and their cat and some stupid sweater, right?
The calendar. You got that next to your calendar.
Yeah. You're probably looking right now at your realtor calendar. So that, and what was funny, I had a situation, I brought that up in a conversation. It's like, a guy's like, you're never going to believe what I'm holding my hand. It's like, what's that? I have a picture of my realtor in a Christmas sweater with her cat in a Christmas sweater. So I thought that was funny. Okay. So that's that, right? But then you have the property manager and all these pieces that sure you're going to pay for property management and say, well, I'm still paying property management, but think about the experience you have. Cori, how many years experience do you have in this?
14.
14 years, right? And you've not just 14 years experience doing deals for you, right? You're doing it for hundreds of people. So you compound that experience. Then you got the people who are rehabbing these houses, managing houses, and they're doing it on scale. When you start looking at from the perspective of experience, it's hundreds of years experience involved, and you got it for market value. Right? So you didn't lose anything. You literally got that for free. So we set that aside. The next job that they have as the CEO of their business is to find the property using their operations team that will stay reasonably rented for the entire time they own it and that they can raise rents on. If they did those jobs correctly, who pays off that $80,000 loan?
The renter.
The renter. The tenants will pay that off. So let's do some more math. That's going to take 80,000.
Okay.
And we're going to divide it by 30 because that's how many years it's going to take the renter to pay that off. Tell me what you get with that equation down to the penny.
Why are you making me do math? It's like 5 in the morning. I don't know. What's that, like 240 something, like, all right. So
the reason I'm making you do math, because I'm making,
he's making me do math. This is why. All right. So 80,000. And then what am I?
Divided by 30.
All right. So $2,666.
$2.66, right?
66 cents.
Now hit your divide button.
Okay.
Right? Because that's how many. So what you're gonna do is that what that is, guys, is they're taking 80,000 and over 30 years, the tenant is chunking it down by $2,666 per year. That's what they're paying for you. Your deposit, your initial investment was how much into the property?
20,000.
20,000. Now hit your divide button and put in 20,000. This will tell you how much your 20,000 is increasing year over year.
133 and 33 cents.
So it's 13.33% is what that actually is.
Yep.
So that would be that your $20,000, and check it out, guys, your $20,000 will increase by 13.33% of the original 20 every year. You have somebody else paying it off. That alone is worthy of saying I kicked ass, correct? I'm a super investor if I'm getting a consistent 13.33% for 30 freaking years. Where else can you actually reasonably predict this on an investment?
You can't.
You can't. It's just.
Well, I love real estate. It's like, it's a hard asset. It's not going anywhere. You can hug it. You know, stocks, you can speculate. You know, there's a lot of speculative things, the coins, all the things. But like, this is a actual tangible asset that you can have year after year after year and keep
exactly.
going.
Then you can pull the money back out. We can get into all those other stuff. So right there, we've shown 13.33%, which is also already up. That baseline is an amazing return. So set that aside. Now we talked about how much cash flow.
What was it? 1%?
$200 a month.
Oh, $200. Yeah, $233.
1% rent to value ratio, right?
Yeah.
So 1% rent to value ratio is equal to what on a $100,000 property?
$1,000.
$1,000 a month. All right. So, and again, sorry, I'm hitting you with all this.
No, it's cool.
Right, with the questions. Have you had coffee?
No, my investors know I'm not a morning person either. I mean, like we're just going in with the math and I love it.
Yeah, I've been up since 4:30. So I'm literally like 3/4 of the way through my day. So we've got, we've established that you're getting $1,000 a month of 1% rent to value ratio. Some will say, well, not all markets are doing that. I say, guys, that's why we went with the 200 a month cash flow. We're finding that all over the place. So, but we live in an inflationary environment, do we not?
We do.
What is the rate of inflation today?
I mean, the government says it's like what, 8.6, 8.7, and depending on who you're listening to, it could be like 18%. Yeah. Yep.
So I'm going to go to a website right here. I'm going to share a screen with everybody here, a place called shadowstats.com. I don't know if you're familiar with this one. I'm going to go ahead and log in and if you're not familiar with this website, you need to get familiar with it. So it's going to let me log in. So when you get there, you want to go to the alternate data tab. You want to scroll down to inflation. And what this chart does is allows us to see what the federal government does with inflation and what real inflation is doing. So they've been tracking it for a very long time. What inflation was being tracked for to show what your cost standard of living was going to be like year over year, right? So if you're going to maintain your lifestyle this year, what's it going to be next year? How much more do you have to make to be able to maintain that lifestyle? And then when they started to have to pay, people who retired and then, they were on other benefits, a inflation increase, they decided to start monkeying with the math. So now you start seeing where it's starting to go downward, right? The target inflation is 2%. But when you look at the real cost of living, it's continued to increase. We put back in food costs, energy costs, segments of housing. So what we're looking at, it looks like we stalled out right around that 8.5 to 8.7% for what they call the CPI, the Consumer Price Index. When you look at the real rate of inflation, we're about 16.5, according to this particular site. So, but we're going to continue to just talk, and I wanted to make sure everybody knew what we're dealing with inflation. We're going to keep talking about why that's important, right? So inflation, because of that, we get to raise rents, correct?
Yeah.
And I say we because I'm a real estate investor as well. What is the average rental increase in the United States today?
Across all different, I'd say at least 10%.
It last I'd heard, it's gone to 12 all of a sudden. Okay. So when you look at like Miami is like 32%, Austin's like 27, Arizona's 24. Then you go to Minneapolis, Minnesota, which is a negative 17. It may have changed, but it's amazing what happens in a market when you start burning down police stations. People that pay their bills move out.
Yep.
Right? People that are responsible for things get out. The people who don't care, they want to burn down police stations, they're going to stay, but you have to keep dropping rents to keep people to pay their bills. So that's the reason why I have an average rent of about 12%. So what we're going to use, we're just going to use 3% as a number to work with in our discussion, because it's very achievable, right?
Yeah, absolutely.
So if you're charging $1,000 a month rent and you're making $200 a month cash flow year one, let's say you raise that $1,000 a month rent by 3% year two. What is 3% of $1,000?
300.
You sure?
No, 30.
30. It's funny. Everybody says 300. Everybody. I don't care your background. Everybody goes to 300. It's just what it is, right? And, but because that sounds, oh, I'm raising my $300. That sounds great, but it's only 30. Then you come to the conclusion like, wow, wait a minute, that's only $30. That kind of sucks. But what's cool about $30 is you're getting an increase that you're not excited about, but your tenants definitely doesn't get excited about earlier either, and they stay in. So you got a $30 increase. So that means your $200 a month year one is now how much year two?
230.
230. Right on. It's not now, if you divide, I'm going to save you this one. If you take $30 and you divide it into 200, you'll find out that that's 15% of 200. That means by raising your rent 3%, you get a compound growth in your cash flow by 15%. Now, I realize, guys, some of you are thinking, wait a minute, there's tax increases, there's increases in insurance, guys. This is a very, very minimal numbers we're working with. Average rental increases is 12. So me using 3 and showing an actual increase of $30 to your cash flow is not very off when you consider the increases in rents are averaging at 12. Most markets I'm seeing, hell, a lot of the markets I'm talking to, it's 8 to 10. So that's why we're using such low numbers. But think about it, 15% compound growth in your cash flow every time you raise the rents by 3%. That is a very achievable thing to experience. Now, here's where it really gets awesome. Does the lender get to raise the payment on the loan because of inflation?
Nope.
And why is that?
It's fixed rate.
Fixed rate. We did a 30-year fixed.
Yep.
So here's what we're going to do. I'm going to show you what this looks like is when what's happening to the lender, because the lender has to accept the exact same payment every year over, or every month, year over year for 30 years. Yeah. So what we'll see here is you've got a $100,000 loan. So it's $532.24 a month for an $80,000 loan. You're paying back a total of $80,000 plus interest of $111,607.12. The total payments to the lender is $191,607. But we've established we're in an inflationary environment, correct?
Yeah, absolutely.
Now, if you went back to the shadow stats that we were talking about earlier, you will see that we've averaged about 8% inflation for the last, God, it's got to be since 2007, averaging at least 8%, if not more. So I'm just going to plug in 8% inflation. With 8% inflation, meaning the dollar, every time you give it to the lender, it's worth 8% less than it was the year before, which is 0.666% per month. That's a mark of the beast right there. So when you're losing that kind of value month over month, the lender's getting paid less and less and less. So when we apply that math, the lender is only making the total value of that $191,000 is $72,535.80. You're increasing your income every single month as you're getting that 15% compound growth in your cash flow, while the lender's getting a compound decline. My question is who's winning?
We're winning.
In a big way. So did you have
that is sexy real estate right there, Aaron? Those numbers look very nice.
Those numbers get people excited. And
Yes.
let me ask you one number. I don't know if you picked up on it. What interest rate do you think I was calculating that at?
Well, you're doing it at 8, but
Well,
yeah.
that was the rate of inflation. What interest rate were those payments calculated at?
Oh, I didn't see.
7%.
Okay.
Right here. The reason I did it 7%, you can verify the numbers, still 191, 607, all that stuff. The reason I did 7% is not because we're at 7% in interest rate right now, because I want people not to be scared of 7%. We're not far from it, right? We're about a point away from it right now.
Yeah.
I don't know if we're going to keep going there. The market continues to keep moving. Right now, we've got a little bit of, I wouldn't say some stagnant movement in the market, but the market is holding somewhat steady. This is the mortgage-backed securities. As these trade, they move the interest rates. So what we're seeing right now, we've been seeing this decline since October of last year. It's just been dropping, dropping, dropping. As this drops, interest rates go up, means money is leaving the mortgage-backed securities pools where we get it. Supply is shrinking, cost is going up. But what we found here is a spot where it looks like we're going to go sideways. We've gotten out of this downward channel. We're heading sideways. Hopefully we keep trading there, maintain this 6 to 6.125% interest rate area that we're in today for your average investor. Everybody's different. That's not a quote. That's just each person might experience something slightly different depending upon their loan size, credit score, all those things. But I want you to not be scared of 7 if it comes, because with where we're at inflation, you're never paying it back anyway. And inflation is helping you make more money because of the fact we can raise rents. So what questions come up with this information?
So I think a lot of people just don't understand what you kind of were just saying, is that it's like, okay, but the interest rates are going up and like, maybe I shouldn't buy because later everything's going to start crashing. And like next year, the rates could go down because, you know, we have a lot of like YouTube University out here where, you know, you have people speculating that the rates are going to go back down. And again, you and I have talked about inflation. If you're borrowing less than inflation, like you're winning.
100%.
So I think it's, you know, the questions that I get are like, you know, are the rates going to go back down? Should I wait? You know, what's going to happen if they do? And again, it's still speculation, but I get that a lot where it's like, if I buy it now at 7, what if it goes down? Did I just totally screw myself up?
Well, and I understand that particular question. Let me just kind of tell you from just Aaron's perspective, and I put my money where my mouth is. I've got 3 houses right now. One has a 6 1/8, one has a 6 1/4, one has a 6.99. I've had them for 6 years. Interest rates went down to where I could have got a 3.5. Did I refinance? No, because it's one of the dumbest things I could possibly do. When interest rates drop and people want to refinance their house, that becomes the busiest time in my business, not because I'm doing a bunch of loans, it's because I'm talking people out of it. And let me explain why.
I was going to say, tell us why. Yeah.
Who do you think benefits from everybody thinking interest rate is the most important thing in the deal?
Your industry?
Yeah, my industry benefits.
Yeah.
Because all they do, in fact, they're talking about it now. The person you finance today on their new purchase is your refinance tomorrow. So they're trying to keep, and what they're doing is they're keeping the loan originator, like myself, engaged in the deal. Guys, quit freaking out about the rates. All you're doing is you're setting up your business for later. And that's why I tell everybody, that's not how I operate. So let's talk about this for a quick second. Have you ever looked at the 30-year amortization table? What does the first 5 years look like?
Same.
Yeah, it's pretty much all interest, right? You're just paying almost it's front loaded with interest for the first 5 years. But do you know how often the industry starts refinancing people?
3 to 5.
3 to 5. So let's just say it's 4, right?
Yeah.
So I had a client, and I don't have it pulled up right here. I wished I did, where we had his amortization table up. We showed where he had a $120,000 loan is what he started with. He paid it down, as I recall, to $94,000 and change. It was just under $6,000 in 4 years. Then you refinance that house, right? When you refinance the house, there's costs associated with the refi. Where do those costs typically go in that refinance?
To your industry.
Yeah, well, they go on top of the loan, right?
And
They go to my industry, right? They'll go to the title companies. They'll go to the appraisers. They'll go to back to recording costs, all to sometimes taxes with the municipality that's there. All these things, right? They'll have more prepaid items, and they'll tack it on top of the loan. In this particular scenario, he had a 94 and change loan, but by time it was done and he got his refinance closed, it was 99,000 and whatever that was. Actually, it was, yeah, he basically got it right within $500 of his original loan.
And did all the paperwork, which is the one thing I hate, is doing all the paperwork.
But he's like, oh, but I'm saving X amount per month and it dropped 1%. And the banking industry says if you drop it 1%, then it makes sense, right? So literally he drove it right within $500 where it was. And 4 years later, what's going to happen? He's going to do the same thing and the same thing and the same thing in 10 and 20.
Because that's what they've trained him to do. That's being in the wheel. That's creating opportunity. That's keeping people in motion. And I get it. I mean, I have loans at 7.2, same like you, and I've had them for years. You know, and it's just like, well, this is just what it was. And I got it. And I got the money fast for what I needed it for. And it didn't matter on the rate because I had access to capital to go buy more opportunities.
And that's that's a whole different argument if you're accessing capital, right? Yeah. But if you're doing it just to drop the rate, like everybody says, am I going to screw myself? Guys, you're not screwing yourself. It really doesn't matter. You're making money back anyway. So what was really interesting is when you looked at what he paid, his payments over that 4 years was $36,000. But he paid less than $6,000 down on his balance. He paid over $30,000 in interest, and then he did it again. And if he keeps doing that, 20 years down the road, he'll have the exact same balance and he's paid a ton of interest. But if he stayed in the deal and just paid that exact same deal from the very beginning, 20 years later, he'd left less than a third of it left to pay off. You guys got to get your mind right that the people who are telling you what you should be doing are typically the ones that are benefiting from it. Like I said, I spend a lot of time talking people out of rate and term refis. Look at your cash out refinances to buy more property. And if that property is going to pay for itself, even if you don't make a single dollar in cash flow, it doesn't put a single dollar in your pocket, but it pays for itself and you don't pull a dollar out of your pocket to pay for it. You are literally making 13.33% on your money annually of the original amount, like we said before. So you're never losing. And that's where people get their head wrapped around it being a CEO of a business rather than the consumer being yanked around by what feels good at that time.
See, this is why I love sending investors to you. This is why we use you. This is like something like just having this conversation and the fact, and I know I literally had one of our clients, one of the investors last week was just called me immediately after getting off the phone with you. And her and her husband weren't even ready to purchase something. And the fact that you spent an hour just educating them, okay, this is what you have to do, this is what you have to do. And I've found that that's why I love like when people talk to your team. I mean, you have a huge team. They're always there. Their communication, which anybody who's dealt in this industry or gotten loans, it's hard because you guys are busy. Like you don't have an hour to be like, hey, what's going on? Let's just have a conversation. But you do it anyway, because it's benefiting the investors, benefiting the clients, benefiting, your team that you work with. And I know you're always providing value. I mean, what are some other ways that you provide value to investors, to our investors to kind of help them in this journey?
Well, one of the main things is, like you just said, is the size of my team. I don't just throw people to throw people. I have people on there that have been doing this since the early 80s. They're extremely expensive people because that kind of experience comes with a cost. But I don't raise my margins, I don't ratchet up my costs to be able to cover that. We just have to do more volume. So I've structured it in a way that I get to spend that 45 minutes to an hour, or Ellen gets to spend that 45 minutes to an hour, or Carla with the new investor to help you structure out what you're planning on doing with your business and your life. While I have all these other people strategically placed to make the deals get done and communicate the situation. Now, you're not going to have a single point of contact with our team. And I realize sometimes that's frustrating, but think of it like going to Chipotle to get a burrito. You don't have the same person. If you said, I want to talk to the manager and he's going to help me get my burrito, he's just going to convey to the person right in front of you what to put on that burrito, right? Just you have one person to talk to. It's completely inefficient. Or you're going to talk to the person with the tortilla. They're going to roll that damn thing up in foil and hand it to you. You're going to have a tortilla. You're not going to have a burrito. Right. So we have about 5 people you communicate with, and it's strategic, is to ensure that we get the deal done while you and I work together to build your business. And you have time to talk to Cori on the operations side, myself on the finance side, to ensure your ability to succeed. Because if you start to fail, Cori, you and I will eventually start to fail, and we violently oppose failure. The other thing that we do is I just showed you a tool that we use to be able to show how beneficial financing real estate can be. And I can't share that tool with you, but I can give you this. And if you got your phones out, guys, I know it's going to be kind of hard to see this because it's in an email form, and I'll shoot this email to you, Cori. You can send out to people.
Okay, cool.
Just got to literally scan this code, or there is a link. And I'm actually gonna be putting these up somewhere on the website. I haven't figured out how to do that yet.
Well, I'll take it. I'll put it in the link also below our video and make sure that they have that.
And I'll get you that, that way you have that link to put in there. And all you have to do is go in there, fill out the information. Don't give me a bullshit name. Just put in your name, your email address, your phone number. We're gonna update this. And it's gonna be a lot more hot-rodded version of this. And so I want you guys to be able to continue to be successful. And we're going to create tools and systems to help you be successful in your real estate venture. Because again, you guys becoming very, very powerful in investing means that we become that. Cori, I'm going to ask you, do you remember who made the most money during the gold rush of the 1800s?
No, I don't know.
It was all the guys who sold the picks and shovels.
Yes, I remember. Okay, I do remember this story.
So you and I are basically pick and shovel salesmen. The difference between us and those guys back in the 1800s is you and I care where they sink that pick or shovel into the ground, because if they just keep digging up dirt, they end up becoming gardeners. And nobody becomes a billionaire as a gardener. It just doesn't happen, right? But if they find themselves some gold and they keep finding a lot of it, they're going to need personnel, they're going to need trucks, they're going to need heavy equipment, and God willing, a damn train. If they need all that, they come to us.
Yeah.
We literally become wealthy as hell providing all the tools for them, because they become wealthy as hell building their empire. That's what this is all about. Everybody needs to come up. There's no taking from the other person. It's we give the best we can to ensure your success, and you continue to work with us because we're ensuring your success. Sound fair?
Absolutely. That is the thing. It's when you're starting your business, you're not always just going to keep shopping the best of the best, the best. Like, if you have a team that is the best, I mean, you've got Rent to Retirement, you've got Aaron, this is something that you have this momentum that year after year after year, you can continue to build. You know what I mean? And that's where you have your team. That's where you build this out. So that, yeah, we want to talk to you year after year. We don't want to be like a one transaction. We want to create a relationship so we can continue to do this and continue to support. And we're all in this together. And everyone, which I love why I work with you, Aaron, is because I know you do the right thing for our investors. And, I never have a problem when I get on the phone with somebody when they're talking about you.
Well, I appreciate that.
Yeah.
And to echo what you said, it's not about the one transaction. I actually lose money on the first transaction, because when you look at the hours and the time that we spent into it, it's when we get to 3, 4, 5, and 6 that it starts to make sense for us. And that's our goal. How do we ensure that person comes back the second, third, fourth, and 10th time? That's the only goal that we have, is to ensure that happens that way. It doesn't do me any good to do one deal. One deal actually is a loss for me, and I can't do that.
Got it.
Well, I appreciate you taking the time. If there's
Absolutely.
anything that we need to be talking about again, well, there will be, because there's more stuff on that app we can talk
Absolutely.
about. Yeah, so
all right. We'll do a whole video just on that, just so everyone can see how awesome and the time you put into it and how that supports investors, and how you can just see everything. So we'll definitely have to do a follow-up video just supporting that completely.
Sounds good.
Awesome.
Well, thank you, and I'll be talking to you very soon.
Absolutely. Thanks, Aaron. Have a great day.
Thanks for watching, guys.
Bye.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.